Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see, step by step, whether it really deserves a spot in a serious dividend portfolio. Today we're examining Cummins Inc., ticker CMY, a global leader in engines, power systems, and energy transition technologies that sits at the heart of trucking, construction, mining, and critical power generation worldwide. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the Max Dividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if CMI is attractively priced today. How this company makes money. Cummins generates revenue through a diversified power solutions model, designing, manufacturing, and servicing engines, components, and energy systems embedded in heavy-duty trucks, industrial equipment, power generation assets, and infrastructure worldwide, serving OEMs, fleet operators, and end users across more than 190 countries. The core earnings drivers are engine segment, diesel and natural gas engines for trucks, buses, construction, and marine applications, with demand tied to freight activity and replacement cycles, plus a global installed base driving ongoing service and parts revenue. Components, turbochargers, filtration, fuel systems, and after-treatment solutions used in Cummins' own engines and third-party platforms alike. Power systems, standby and prime power generators for data centers, healthcare, and utilities, serving mission-critical environments where reliability is non-negotiable. Accelera and energy transition, battery systems, fuel cells, and hydrogen solutions positioning Cummins for evolving regulatory and customer requirements. In other words, Cummins sits at the center of a vast global fleet of trucks, machines, and power assets requiring continuous maintenance and upgrades. Exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple: at least 15 years of consistent dividend growth. Cummins clears that bar with 17 consecutive years of increases. Annual dividend per share climbed from roughly $1.25 in the early 2010s to approximately $7.60 today. A progression signaling robust cash generation and a management culture that treats the dividend as a permanent priority, even through freight cycles, emissions transitions, and commodity swings. Step 1 passed. Cummins behaves like a genuine dividend eagle with a resilient dividend growth record across multiple economic cycles. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. On a 10-year view, Cummins' revenue expanded from roughly $17 billion in the mid-2010s to the low $30 billion range most recently. The path wasn't perfectly smooth. CMY is shaped by truck production cycles, freight demand, commodity costs, and emissions regulation changes. But the long-term revenue base has grown materially through OEM relationships, components expansion, and power generation penetration. Sales growth passed. Cummins' durable revenue trend reinforces its case as a diversified power solutions platform with a credible foundation for dividend continuity. Second pillar, profit growth, the fuel. Over the past decade, profit increased from roughly $4 to $5 billion in the mid-2010s to more than $8 billion in recent years. That progression suggests CMY is not dependent on a single exceptional truck cycle, but supported by a profit engine capable of expanding through freight volatility and regulatory change, reinforced by operating leverage and a growing mix of components and service revenue. Profit growth passed. Cummins' expanding earnings base strengthens the reliability of its dividend foundation. Third pillar, net income, true strength. Over the past decade, net income starts near roughly $1.0 to $1.5 billion in softer years, climbs into the $2.0 to $2.5 billion range during stronger periods, and reaches close to $4.0 billion at its recent high before moderating again. That variability reflects the cyclical markets Cummins serves. The key signal is that profitability remains intact across downturns and continues compounding over time. Net income past. Cummins demonstrates a resilient, cycle-tested earnings profile, reinforcing that dividend growth rests on durable operating strength. Fourth pillar. Dividend payout safety. Protecting passive income, Cummins' payout ratio has typically moved between roughly 30% and 50% in stronger earnings years, with one notable surge above 100% during a period of sharply reduced profits before returning to more typical levels. The spike reflects cyclical earnings compression rather than a change in dividend policy. Dividend payout safety. The payout ratio has at times exceeded 100% and since returned to a sustainable range, underscoring the need to monitor coverage during cyclical downturns, even as the dividend itself stayed on its growth path. Fifth pillar, debt burden, avoiding traps. On a 10-year view, CMY's debt ratio has generally ranged from the low 0.5 area to just under 0.7 at its peak, most recently sitting close to 0.60, a reasonable band for a global manufacturer exposed to cyclical end markets and energy transition investment needs. Debt burden past. Cummins' leverage profile appears controlled, supporting the view that the dividend is backed by balance sheet discipline rather than excessive financial risk. Cummins' overall financial score comes in at 98, very safe in our framework, signaling strong core fundamentals and cycle-tested durability. Does it fit our plan? MaxRatio combines current dividend yield, dividend growth, and financial strength to classify stocks as growth eagles, balanced eagles, or income eagles. Cummins' MaxRatio is 2.36, placing it in the growth eagle bucket. With a dividend yield of 1.11%, CMI is not an income anchor today. The appeal is in the combination of 45% cumulative dividend growth over 5 years and 17 consecutive years of increases. A structure where dividend expansion, not headline yield, supports long-term total return. Cummins fits investors who want steadily rising income from a financially durable industrial franchise rather than a high-yield bond alternative. Is the stock undervalued today? Versus peers, Cummins screens as fairly valued in the Max Dividends app. The market is pricing CMI broadly in line with comparable industrial names, neither a clear discount nor an obvious premium. Versus its own history, Cummins has generally traded at an average PE in the high teens to low 20s range over the past decade. Today's multiple stands meaningfully above that historical norm. Investors are paying more than usual for each dollar of CMY's earnings. On yield, Cummins pays about 1.11% today versus a longer-term average near 2%. The dividend keeps growing, but a stronger share price has compressed the starting yield well below its historical norm. Analyst consensus sees modest upside, with a 12-month price target implying roughly 8.89% upside and a wide range reflecting real uncertainty around freight demand and truck production cycles. Final decision. Cummins is a mission-critical power solutions provider. Not a speculative headline story, but a scale-driven engineering franchise supported by recurring service demand and long-term OEM relationships. It screens as fairly valued versus peers, trades above its own long-run average multiple, and offers a yield below its historical norm. A reasonable, though not discounted, price for quality. For dividend investors, CMI fits more naturally as a growth eagle and dividend compounder. A 1.11% starting yield paired with 17 years of consecutive increases and the potential for that payout to keep rising as Cummins executes across freight, industrial, and energy transition markets. The key watch items are truck production cycles, commodity volatility, and whether earnings growth can justify the current valuation premium. Subscribe for more analysis. This is not investment advice.